Now on stage, sovereign spreads and corporate financing, shaping Greece's future competitiveness. Moderating this session, Alexandros Koliavras, President at the Hellenic Association of Treasurers, Deputy Chair at EACT, and Director, Head of Treasury Finance and Finance Transformation at ING Americas, Chariton Papatriantafyllou, Treasurer at the Hellenic Association of Treasurers and Senior Officer for Strategy and Investments at Alpha Bank, together with honorable guests Petros Migiakis, Head of Banking Affairs and Capital Markets Division at the Department of Economic Analysis and Research in Bank of Greece, and Dimitrios Tsakonas, General Director at the Hellenic Public Debt Management Agency. Please welcome our panel to the stage.
Well, good morning again. It's a privilege to welcome Mr. Tsakonas, Mr. Migiakis on the stage to a session on Greece sovereign spread, very important topic for all of us, the corporate treasurers, the bank treasurers, and of course, the public sector. One of the most critical drivers of our financial landscape, from the crisis years of record high yields to today's normalization spread, reflect our reforms, resilience, and credibility. They are not just numbers. They set the cost of funds for the state, the banks, and the corporates, directly shaping the growth, competitiveness, and investment. Lower spreads means, of course, a cheaper financing, stronger investor confidence, and greater opportunities for Greek companies to expand globally. With this perspective, I look forward to our speakers' insights on sovereign risk and spreads, shaping corporate financing and Greece's future competitiveness. To begin with Mr. Tsakonas, thank you very much once again. How have Greece's sovereign spread evolved in the last 2 to 3 years, and what do we think are the main drivers behind the current levels?
First of all, thank you very much for having me here. It's a great honor for me. And to answer directly to your question, the last 3 years, we have seen an enormous tightening as far as the GGBs, the Greek government bond spreads, versus other Eurozone peers, especially versus Bund. We're talking about approximately or more than 200 basis points tightening between, let's say, from June, July 2002 till now. This impressive tightening happened mainly for 2 reasons, fundamental ones and technical ones. As far as the fundamental ones, I need to stress that Greece, after the implementation of 3 fiscal adjustment programs and all structural reforms that have been implemented since 2010 till now is a machine that produces primary surpluses, if I need to put a title. We have achieved to deliver on a yearly basis, the last 2.5 years at least, primary surpluses that exceeds the actual annual interest payments. That means that by definition, the Greek debt is reduced every year. Implementation of structural reforms. Everybody knows what has happened in Greece the last 10 years, 15 years, as I mentioned before. Needless to say that, due to these structural reforms, we have seen the unemployment rate being at the levels of much lower than 10%, when in the beginning of the crisis or in the middle of the crisis was the rate exceeded the 25%. We have seen also the GDP growth rate, the real GDP growth rate being more than double of the European average. And this provides a lot of confidence to investors in order to invest in all Greek assets, especially the Greek government bonds. Now, the technical reasons are the following. After the imposition of the PSI, which is part of our nasty past and we tend to forget, but I need to remind all of us that this happened, and a lot of people, perhaps among all of you, lost their money and their jobs. Since then, or at this time, we essentially eliminated the tradable debt portfolio. From 265 billion that we had at that point of time, we had as an outcome, after the imposition, less than 80, close to 70, if I remember correctly. Then the debt buyback took place. We lost, in quotes, another 31 billion of tradable debt, and we started rebuilding our curve from zero, let's say. In my career, the last 31 years that doing this job, we have rebuilt the yield curve, the GGB, the Greek government bond yield curve, for almost 5 times. The last one is this one. So, trying to rebuild the yield curve, you need, first of all, to provide provide supply, to introduce new lines, liquid benchmarks in the context of Eurozone, and to increase the tradable debt. Now, after a lot of efforts, the tradable portfolio is close to 98 billion. But the free float, because of the PPP, because of the Greek banks' holdings, because of the general government entities' holdings, is close to 25 billion. Having only 25 billion in the market, you have, by definition, the so-called scarcity value. So you can see, we have seen a spread tightening due to price increase because of the scarcity value. The scarcity value, for the scarcity value, we have contributed in this context, in the scarcity value, to increase the scarcity value, due to the restructuring of the Greek debt, the favorable structure of the Greek debt. We're talking about an extended maturity. Our debt looks like a bond with 19 years weighted average maturity. In fixed rate, 1.7%, if we need to incorporate also the deferral of interest payments, a technical discussion, if you want to elaborate, I can, but leave it aside for the time being, 1.7%. That means that by definition, our gross financing needs for the upcoming years, at least 20 years, and having in mind the structural reforms and the fiscal adjustment, the fiscal policy and the fiscal adjustment that we have seen so far, i.e. delivering every year primary surpluses that exceed the annual interest payments, the annual gross financing needs of the Hellenic Republic is a tiny amount. We're talking about 15 billion on average, out of which, you need to bear in mind, 10 billion, or take into account that 10 billion more or less is the annual primary surplus the last 2 years, and this will be the case next year and the years to come. Then what is the remaining room for funding activity? Just 5 billion. So increasing, by having increased the rating, i.e. a lot of investors have strong willingness now to buy GGBs, especially indices being incorporated, GGBs being incorporated in indices, etc., etc. There's a lot of demand, there is lack of supply, there is lack of free float, and this is the technical reason that we have seen also this spread tightening.
Right. When we were talking about accessing the bond market, right? How is Greece positioning itself towards other Southern European markets, Eastern European markets?
Yeah. First of all, we should not be being arrogant. Everybody knows now that I mentioned before that 3 years ago our spread versus bond was close to 280 basis points. Now it's close to 65, between 65 and 70. Now we are much tighter compared to Italy, close to 17, 18 basis points in the 10-year sector. 10 to 11 basis points in the 10-year sector versus France. And if I need to stress something, our mission to be accomplished is to be even tighter and close to Portugal. Why Portugal? Because Portugal is very similar to us. But why we have seen this? For the although our debt is much higher compared to these countries. And I need to focus first on the Eurozone partners, and thereafter we're talking about of other countries that they don't have euro as their lawful currency. Although we have higher debt to GDP ratio, due to the fact that, and I need to recall what the new minister said, that the fiscal policy in Greece is not anymore a policy, it's a regime, it's a new regime. We are going to be in compliance with the fiscal framework, the new fiscal framework, and believe me, we are going to deliver every year, as I mentioned before, primary surplus, that the overall headline balance will be always positive. This provides a lot of confidence, and this also leads to further tightening of spreads and in any case, in reduction of the Greek debt. The Greek debt, both in nominal terms and in terms of debt to GDP ratio. Now, we are tighter than Italy. We are tighter than France, the way that I described. We are just, if I remember correctly, wider 10, 15 basis points versus Spain, 25 to 30 basis points versus Portugal. As I mentioned before, this is the target. For the reasons that I mentioned before, fundamental reasons, and also lack of supply that creates or has as an outcome the scarcity value that I mentioned before. I need to stress that there is a side effect, the lack of liquidity in the secondary market. We are going to do our best. We have already done a lot of things in order to improve the secondary market liquidity. We are going to do our best in order to improve it even further, but there is a side effect. Now, as far as other countries you mentioned before, like Poland, perhaps, Czech Republic, etc., etc. First of all, I need to stress that these countries do not belong to Eurozone, so they have much more flexibility. On the other side, they don't have such an enormous, in quotes, debt, or debt to GDP ratio. For good or for bad, for good, if you ask me, we have abandoned our sovereignty as far as the implementation of monetary policy is concerned. The others have much more flexibility compared to us. Let me tell you the following. Perhaps there is an opportunity for Greece to issue a bond in dollars. The after-swap cost could provide, let's say, an opportunity of 5 basis points less lower cost, funding cost. But on the other side, we don't have such a luxury. We need to preserve a liquid benchmark yield curve. Why? Because as a benchmark, it's the benchmark of the whole Greek economy. So we cannot lose, let's say, opportunities to increase the liquidity in the euro-denominated bonds by issuing in dollars or in yen or in whatever. The others can do this. And on the other side, the starting point as far as the debt to GDP levels of others was much lower compared to us. So there is a comparison. They have more opportunities for the reasons that I mentioned before, but on the other side, we have a crystal clear framework, and I'm referring to the fiscal framework. We are committed that we are going to follow this framework, and the results, I think that are more than clear and more than concrete.
So, very interesting point. And from the side of the government, right, what is the government's strategy to ensure sustainable debt management and contain the spreads in volatile times? For example, when we have ECB policy shifts, when we have geopolitical risks, I mean, a lot of things are happening around our area, right?
I want to rephrase or to rename. We're not talking about just for one government. We're talking about of the Hellenic Republic. Why I'm saying so? Everybody across the political spectrum is committed with the new fiscal framework. It's obvious. You know, nobody can say that we are not going to follow what has been agreed between or among Eurozone partners. The fiscal framework for us is the Bible. We're going to follow 100%. So if we follow this, and given the fact, something that it is not well known, apart from those that were involved back in 2010, there are a lot of agreements in place, published in the National Gazette, in the European gazettes, etc., etc. But the most important and the most valid and the most, valid, yes, agreement that we have in place is, which is not written, but it's the spirit of all other agreements and of the new fiscal framework, is that in case of Greece, debt should not create debt anymore. Due to this, we have the commitment to deliver, as I mentioned before, every year primary surpluses that should at least be being equal to the actual annual interest payments or even to exceed them. So by definition, and for a long period of time, we need to reduce, and we are going to reduce our debt even in absolute terms, in nominal terms, not just. Having also in place a holistic cash reserves management. Perhaps you don't know, back in 2010, the Hellenic Republic didn't know how much was the cash reserves of the whole spectrum of general government entities. Now we know. Now we have full access. Now we're talking about of a family, not just of the father with the kids. We're talking about of a family. The family, as we speak right now, has 44.1 billion. This was the last day, yesterday's, let's say, number. 44.1 billion cash reserves, i.e., an amount that fully covers our gross financing needs for the next 3.5 years at least, without doing anything. This is my time, the public servant's time. You know, the incompetent guy, the lazy guy, etc. I can do nothing till my retirement. And believe me, after 3.5 years, we will be in a very good shape as we are so far. Last but not least, the proactive debt management. The debt portfolio, the Greek debt portfolio, has no risk. Let me repeat myself. It looks like a bond with 19 years maturity in fixed rate, full fixed rate, without interest rate exposure. On the contrary, we are overhedged. We were proactive. We have done a lot of trades after 20 years, for 20 years. The time horizon of ours is not just the next elections, not even the end of the year, or not even the next elections. Our time horizon is the next 2 generations, i.e., till 2050. The time that we're going to get rid of the last euro of our outstanding amount of debt. So, being proactive, having eliminated the interest rate exposure, the FX exposure, the inflation rate exposure, the counterparty risk, because we have all derivatives that we have in place. First of all, we have expanded the investors' base. Let me remind you that we have followed so far a funding activity, or our funding activity is implemented through syndications, not because we want to give generous fees to our primary dealers, but because we want to control allocation. 90% of our new issuances is allocated to foreign investors. So, by having expanded the investors' base, by being proactive as far as the debt management is concerned, having this favorable structure and delivering every year the primary surpluses that I mentioned before, this provides a lot of confidence to investors' community that most probably, irrespectively of where are going to be the level of interest rates in the upcoming months or years, the GGB spread will be even tighter. Not the way that has happened so far, 200 basis points or more, but we're talking about a further tightening.
Right.
Thank you, Dimitri. And thank you for the valuable insights on the sovereign debt, and also for the optimistic outlook of further tightening. The reason for the panel is also that we want to connect the sovereign debt, the sovereign spreads, to the real economy, how it transmits to the banks, how it transmits to the corporates. And for that, we also have Petros with us. Petros, welcome.
Thank you. Thanks for having me.
Part of your job, a key metric of yours is the transmission, how it transmits from your policies to the banks, to the real economy. I want to start by asking you, how do you see the sovereign spreads transmitting into the banking world? What effect do they have?
Okay. Thank you very much for having me here. First, let me use the regular central bank disclaimer. I will use my personal views that originate from my analysis and do not necessarily bind the Bank of Greece. So now, the question here is a very important one. We must all realize that we are all into it. There is no other way to escape the sovereign or country ceiling but exiting the country. So, the sovereign spreads have an information content. They work as a mechanism for, let's say, a market discipline device in 2 ways. First, they are the benchmark for pricing everything that falls into a specific legal jurisdiction, a sovereign state. And second, they serve, like what rating agents say, the country ceiling. They let's say, define to a large or a smaller degree the maximum rating a legal entity in a given sovereign can take. Now, at the present instance, I would say that sovereign spreads translate into a pull-down factor and not a pushing up factor for both bank bond yields and corporate bond yields. What we have seen is that since the first positive outlook for Greece's upcoming rating upgrade to the investment grade, which was given in April 2023, up until today, bank bond yields have been compressed by about 450 basis points on average, in weighted average terms, according to the outstanding amounts of the total bonds. This is similar to what we have seen in corporate bond spreads as well. So they do translate both to the upside and to the downside. We are currently seeing to the downside for the reasons Mr. Tsakonas said. I would say that this is, let's say, the opportunity, and I would also like to give some insights about the global corporate bond market in the in the coming questions.
All right, thank you. And moving a step forward then, first let's see the traditional bank lending.
Yeah.
How does that translate there to the corporates? Do you see limits from the bank lending to the corporates? Do you have tools to offset these factors?
Yeah. So we have seen, as I said, that during the crisis there was a market discipline. Now, the crisis is no longer a thing here. It's no longer into action. But what banks what our analysis says about bank lending is that banks in Greece are now should now be seen as an efficient enhancing mechanism, meaning that they are much more cautious than they were, and they should be much more cautious than they were before the crisis. And they do lend to those entities that truly are valued as credible entities. On the other hand, there are regulatory disciplines that they must follow, so they must meet some ratios, let's say, liquidity ratios and other stuff that they also are binding. The bank lending, I wouldn't say that it is, let's say, bound right now from some kind of sovereign contagion effect that it's no longer working. The bank lending is either bound by bank strategies, or it is, let's say, accompanied by RRF schemes and other official lending schemes. Deposit flows, on the other hand, we have seen a lot of liquidity coming to banks, exactly because investor confidence means that depositor confidence has also returned. So I think that as economic conditions prove to be resilient in the current turbulent conditions that we are faced with, I think that also the comparative, let's say, the relative bank lending outlook will be better than what it is in other countries that are not faced with such benign economic conditions as we do.
Yeah, very insightful. And I want to also see how this translates to the corporates and their competitiveness in the real economy, especially if we compare them to European peers. How do you see the spreads affecting them?
Okay. This is where I would like to give my insights. Now, Greek corporates have issued in the previous years, let's say the previous 5 years in the bond market, with a yield or a coupon rate of about 5 to 6% weighted average. Their European peers had a lot more compressed yields, about 1.5 to 2% for BBB rated companies. We are sitting globally in a high level of debt situation. This may seem awkward, but Greek corporates, to my point of view, sit on a comparative advantage, exactly because of the state of the sovereign. I mean that because, let's say, Greece is right now a success story for the reasons Mr. Tsakonas outlined, we could be seeing, or it is more probable than not, that we could be seeing Greek corporates' cost of funding coming down, and at least in their balance sheet, their interest expenses will come down at the same time as the interest expenses of their European peers will be coming up. And this is not from me, it is from a forthcoming official report on corporate debt globally from the Organization of Economic Cooperation and Development that you will see at the end of the year. So I think that, yes, I get the point. Let's say the country ceiling and the cost of funding is a burden for Greek corporates, but we also should see things in a global comparative scale. And at this point, I believe that we are seeing the reversal of the crisis in every sphere in Greece. And this includes corporates, this includes banks. Hopefully, this includes households as well.
And you as a central bank, what do you use in the previous years to mitigate this pass-through effect of higher spreads and now to facilitate the pass-through to the corporates?
This is the QE question, right? Now, as a student of Milton Friedman, I would say that the correct way to address this question and going counter-cyclically according to what we see right now is a non-interventionist way. But yes, I get the point. Central banks did support bank lending and also funding from the markets through their, let's say, operations, direct market operations, not only the QE asset purchases, but also some other features like the loan level initiative of the ECB or some term auction facilities of the Fed, and they did support the market funding. Now, we must say that this is not easy to replicate, okay? Because there are a lot of excess reserves in the global economy. I think at the last time I checked the database of the Fed, at the US there is about $4.5 trillion of excess reserves, and in the Eurozone there is about 3.5 trillion euro of excess reserves. So it is not easy to replicate, but in the case of a global financial crisis, I would say there.
That's a nice pass to my next question. You just talked about the markets, the capital markets. We talked a lot about the bank lending already. I want to ask a question to both of you. You both mentioned the sovereign ceiling, the famous sovereign ceiling, or infamous maybe. How do you see that affecting the capital markets for corporates? And do you think it's still relevant? Is it still prevailing? Maybe Dimitrios, you first.
Yeah, thank you. Let me give you a picture. The Hellenic Republic was and still is the icebreak ship. We need someone strong enough, in our case, the Hellenic Republic, the PDMA, to break the ice in the North or South Pole. And thereafter, the little boats or the ships to follow. So we have delivered, we have accomplished this mission. I'm very glad to see now companies like the ones that sponsor you to achieve even better with extrovert, let's say, activities, etc., being extrovert, delivering even lower cost of funding for themselves and even better rating. What we should do is to continue delivering as far as the fiscal targets that I mentioned before and the implementation of structural reforms. We need also, which is not minor of importance, on the contrary, this is the details that always devil is hidden in details. We need to improve, as far as the GGB market is concerned, the secondary market liquidity, to find space for funding activity. That's why we have done a lot of liability management exercises so far, switch and tender offers, old bonds with new ones, replaced by new ones. That's why we have announced the early repayments of the bilateral loans that will take place 10 years at least earlier compared to their maturity. All this in order to find space for funding activity, to provide supply, to improve the secondary market liquidity for the final fine-tuning. We were, and perhaps we are still the icebreak ship for all companies. Our commitment is to continue building or preserving a liquid benchmark yield curve to deliver even further tightening of the spreads and the bid-offer spreads, which is a cost for an investor, in order to improve the cost of funding of the Hellenic public, to lower even further the benchmark yield curve, which is the sovereign's yield curve, because this is the benchmark for the whole Greek economy, and also this is the tool in order for an investor coming from abroad, a foreign investor, to find or to calculate, following the fundamental analysis, the fair values of all Greek assets, and the lower the discount rate, the higher the fair value. So this is our mission that should be accomplished, and we will continue doing this.
And we have achieved the investment grade stability, right?
Indeed.
The last year, I think we fought
And
quite
we're
hard.
already one notch higher.
One notch higher. What can we do? Because we always want to be better and better, right? What can we do to further reduce the sovereign spreads on the midterm?
As I mentioned before, being consistent with what we have done so far and with the policies that should be implemented, continuing delivering as far as the structural reforms is concerned, the justice, for example. I strongly believe that being back to where we used to be in terms of rating before deciding to jump from the roof, i.e. the A+, is a doable target, but it will take time. Perhaps having in mind a rule of thumb, a simple rule of thumb that you take an additional notes as far as the rating is concerned every 2 years, one for the change of the outlook from stable to positive and another one. This is a simple rule of thumb. We can accelerate our efforts and to accelerate this achievement, but okay, we need at least 6 to 8 years to achieve the A+. If you have visited our website, you will find in the investor relations presentation, in the investors' presentation, that in 2030-31 we will be the debt to GDP level will be close to 120, which makes sense. And as I mentioned before, we need to be consistent and to deliver the targets, especially the fiscal targets that has been set, and being in compliance with the new fiscal framework.
Petros, if I can ask the same question.
Yeah. I fully agree that Greece is on a positive credit trend. Let's say if we take the market view, the market implied rating from several rating agencies is in the boundaries of BBB to single A already. Our distance from BBB weighted average yields is about minus 30 basis points, and that one from single A weighted average yields is a positive about 10 basis points. So we are much closer in market-based indicators to single A's than to BBBs already. And I think that this also answers to the competitiveness question. So the sovereign ceiling, it's not, let's say, I will not jump into the shoes of rating agencies, but what I understand is, let's say, the macroeconomic and operational environment in a given country is very difficult to hedge against, right? So what this means is that at the current instance, the credit trend that is positive for Greece also benefits Greek corporates and Greek banks. And I think that we should continue in this way. Several European initiatives, for example, the Savings and Investment Union, but also investors coming to Greece, the net investment, from the net investment position, we have seen a 6 billion inflow in government, bank, and corporate bonds already. In Greek equities, about 7 billion. So I think that the trends from the market are very positive, and I think that we will keep this kind of pace.
Well, I fully agree, and we need to understand that the P&L in the Greek corporates is quite important. We can agree that the spreads not only affect the sovereign debt, right? It's affecting also the bank funding, the corporate borrowing, and of course the competitiveness of the country. Greece's future depends on narrowing this gap with other EU peers, strengthening the resilience, and of course collaboration between the state, the central bank, the corporates, and of course the treasurers, right, who are administrating all this liquidity, is quite essential. Thank you very much for coming on our stage, Mr. Tsakonas and Mr. Migiakis. It's a real honor. Thank you.